If you're following Tesla, it's incredibly easy to look at the current headlines and get the wrong picture. There's a common blind spot right now, a narrative that's causing a lot of smart people to misinterpret what's actually happening with the company. It's a blind spot that could be costing portfolios dearly. Hey, this is DataCat. I spent years as an analyst inside a Fortune 50 company, and my goal with this channel is to share the kind of data-first framework we used to see things clearly. Because let's be honest, the most valuable information is often buried under a pile of, well, stuff you'd find in a litter box. So, in this video we're going to unpack the real story behind Tesla's current stock performance. And just to put the most important point on the table right away, here it is. The market is valuing Tesla like a car company that's having a bad quarter. The fundamental error in that thinking is that Tesla stopped being just a car company years ago. You're looking at a manufacturing and AI powerhouse that just happens to sell cars for now. You see, the sentiment around Tesla right now is undeniably negative. You don't need a fancy degree to see it. As of early July 2025, the stock is hovering around $295 a share. That's a drop of about 22% year to date. The headlines are screaming about disappointing Q2 delivery numbers. They delivered about 384,000 vehicles, which is a 13% drop from the same time last year. That signals some real demand challenges, especially in the US and China. On top of that, they've been slashing prices to stay competitive, and that's squeezed their profit margins. We're seeing gross margins around 16% and net profit margins shrinking to a skinny 2%. For a growth company, those numbers make investors skittish. It's like offering a cat a salad, and I will just knock it off from the table. And then, there's Elon. His political activities, the America Party announcement, the public spats. It's all adding a layer of chaos that the market absolutely hates. It creates uncertainty about government subsidies and makes you wonder if the head cat is focused on catching mice or just knocking things off the shelf. We're seeing buyers in places like Germany getting cautious. So the bearish case is simple, it's loud and it's right in your face. And if you stop there, you'd probably sell. Many people are. But that's the first level thinking. That's what Wall Street wants you to focus on. But now let's go deeper. This isn't the first time we've seen this show. Tesla has a history of clawing its way back from the brink of bad sentiment. Remember back in 2022 and 2023, with the whole Twitter acquisition? The narrative was that Musk was alienating his core customers. The stock took a beating. But while the world was distracted by social media drama, Tesla was quietly pushing forward on innovation and operations, and the stock stabilized. Or look at early 2025. The Cybertruck recall and production delays sent another wave of panic through the market. Again, the focus was on the immediate problem. But historically, Tesla resolves these technical setbacks, reaffirms its quality, and moves on. Each time the cycle is the same: a storm of controversy, a steep drop in valuation, and then a rebound driven by the company's underlying operational strength. The current situation, with the Q2 numbers and political drama, fits this pattern perfectly. The market is acting like a cat chasing a red dot, obsessed with the immediate flashy movement while completely missing the person holding the laser pointer. This brings us to the core investment thesis for Tesla in July 2025. This is the part the headlines usually miss. The primary mistake people make is trying to analyze Tesla by comparing it to Ford or GM. As the analyst Tom Lee so brilliantly articulated, Tesla's real strength is its mastery of advanced manufacturing. This is intellectual property they developed in one of the hardest manufacturing sectors in the world. Lee's view is, if they can dominate manufacturing of autos, Tesla will dominate whatever industry requires manufacturing in the future. They've built the expertise to produce almost anything at a lower cost. This directly affects your retirement timeline, because you're not investing in a car company, you're investing in a manufacturing revolution. And that's before we even talk about the AI. Tesla's fleet has logged nearly 3 billion miles with full self-driving active. 3 billion miles. That's a data moat so wide and deep that competitors can't even see the other side. This data feeds their AI, creating a learning loop that gets smarter with every mile driven. The data proves its worth. As of the first quarter of 2025, Teslas on autopilot had one crash for every 7.44 million miles driven. For drivers without it, that number was one crash for every 1.5 million miles. The data is undeniable. This isn't a side project. They invested $10 billion in AI development in 2024 alone, supported by their own custom supercomputers. So Pillar 1 is understanding you're not buying a car company, you're buying a manufacturing and AI leader. Pillar 2 is the product pipeline. Current revenue is tied to cars, yes, but future valuation hinges on what's next. The robotaxi network is already rolling out in Austin. That's a plan to revolutionize urban transport. But the real game changer is Optimus, the humanoid robot. They plan for mass production of 10,000 units in 2025, with a projected cost under $50,000 per robot. Think about what that does. It could redefine labor in factories, warehouses, agriculture, you name it. This is how Tesla transforms from a company with a 16% gross margin to one targeting the massive high-margin markets of autonomy and robotics. Tom Lee said it best, they are by a country mile leading in the US in terms of robots. And finally, Pillar 3 is the Elon factor. And no, I don't mean the political drama, I mean the founder-led vision. As Tom Lee noted, the companies that truly changed the world over the last century were led by founders who saw things differently. Musk Ventures, Tesla, SpaceX, Starlink, Neuralink, XAI are not separate silos, they are a deeply interconnected ecosystem. Starlink can provide global connectivity for Tesla vehicles. XAI's models can be integrated into the cars. Engineering talent is shared. Investing in Tesla is a bet on this entire synergistic vision. And Tesla is the main way for you, the public investor, to get a piece of it. So, what's next? The Q2 earnings report on July 23rd will be critical. We'll get updates on margins and cost cutting. We'll be watching the robotaxi expansion and any news on the Optimus rollout. To wrap this all up, the market is currently tangled in the yarn of short-term delivery numbers and political noise. It's a compelling distraction. But the long-term thesis rests on pillars that are much stronger and far more significant. A dominance in advanced manufacturing, an almost unbeatable lead in real-world AI, and a pipeline of world-changing products. The current 27% year-to-date pullback is what analyst Tom Lee calls overdone. It fits a historical pattern of short-term panic, creating a potential long-term entry point. The question you have to ask yourself is this: are you investing based on the twitching tail of quarterly reports, or are you focused on the heart of the animal? So, if you found this breakdown useful, consider hitting the like button. On YouTube, that little thumb is basically the algorithm's version of a cat's purr. It signals that this was good data and helps other people find it. And since this channel is new, subscribing is the single best way to show your support. I'm not selling courses or anything like that. I just want to build a community focused on clear, data-driven analysis. It's free and it ensures you won't miss the next breakdown. Let me know your thesis in the comments below too. I read all of them.